Hello again from Core Wealth. We'll be doing the wrap up today for August. It's now spring in the southern hemisphere, and we're going to do things a little bit differently today. And that we'll first look at how markets did in the month of August, and then I'll make a few comments around the economy and what we're seeing happening locally and globally on the economic front, and then talk about some of our expectations into the future. If we look at the markets for the month of August, developed world equities were the best place to have been, up over 6% for the month. Emerging market equities also good, up just under 2% for the month. South African equities slightly negative, 0.3% for the month. But within the market, we saw a number of managers adding significant outperformance. PSG was an example within our portfolios, adding more than 5% outperformance during the month. Currency markets ended the month actually flat, but were quite volatile during the month, moving a full rand against the other major currencies around the world. Listed property underperformed a lot and was down over 8%, but again within that we saw some of the managers developing or generating significant outperformance versus the benchmark. If we look a bit longer term at all the markets, the general pattern looks the same. Offshore equities, best place to have been, developed markets first, then emerging markets. Listed property in South Africa, the weakest market over this period, down significantly over longer periods of time as well. The positive we are seeing is that we are seeing absolute returns now starting to show from South African equities, and importantly we're seeing the underlying managers generating some good outperformance within those markets, both globally, both in South African equities and also in the listed property markets. So you'd be correct in assuming that given that listed equity markets in South Africa were slightly negative, listed property was down, that you could be expecting to see negative returns in most of our models. Actually, that wasn't the case in August, and the reason being that there was some good outperformance by a number of managers versus the benchmarks. I'll give you two examples. One is PSG, who we use it in many of our models, and their flexible fund, for example, outperformed the all-share index by nearly 5% in the month, giving some good positive returns to those funds or those models that use it. On the listed property front, although listed property was down some 8% for the month, bridge fund managers who manage the Net Group Property Fund actually generated outperformance of around 5%, so they weren't down as much, given that they don't hold many of the big stocks that fell during the month. They have more of a smaller cap focus. This just illustrates the benefit of having different managers who have different ways of generating performance, and over time you see the benefit of that. We're allocating a little bit more time to the economic overview just because it's often helpful for business owners, and we are privileged in that we get to see a lot of the direct economic information rather than just reading it in the newspapers, which have their own slants usually. So if we have a look globally, economic activity is picking up on the back of Corona now starting to taper off. Most countries have peaked in terms of infections, still one or two. India still probably hasn't peaked as yet, but definitely seeing economic activity picking up. Progress in terms of the vaccines are also going well, and that's something that again will enable economies to open up even more, international travel to start again, tourism to start again, which will be good for economic growth. So one of the big influences on both markets and economies for the rest of this year is going to be the US elections. If Donald Trump gets elected, that will cause a lot of volatility, or a lot of volatility is expected because of the animosity between the US and China under his leadership. At this stage, the polls are indicating that Biden is probably ahead, but there's still a long way to go, and so it's just something one has to be aware of, and that could cause volatility in the months ahead. The US markets look very expensive at the moment, and that is a caution that we are holding in our investment views. So governments around the world have lent a lot of money, and they've used that money to stimulate their economies to basically combat the economic impact of Corona. They've got to pay that debt back, and one of the ways they can make it easier to pay back is if they allow inflation to rise. And one of the ways they can see inflation rising is if currencies are allowed to weaken somewhat. We expect the US, and we've started to see the activities around this, to allow the dollar to weaken in coming years. That type of environment is generally good for emerging markets, and it's one of the reasons why we've had an overweight exposure to emerging markets, and we expect to see benefit from that in the coming years as more and more investors globally allocate more to emerging markets. Economic growth results have been coming out from around the world. Most recently, we saw the US economy shrink by 1/3 in the second quarter of 2020. The UK economy wasn't much better than that. And South Africa's results came out this week, where we saw the South African economy shrink by 51% in the second quarter of 2020. Horrific numbers, but not surprising actually, because the industries and business has been closed for the bulk of the second quarter. Lockdowns meant that April was nothing was happening, May wasn't much better, and June things were only just starting to get going. If we look at data from things like Google, which tracks activity on the roads and things like that, in the second quarter the turnaround is expected to be material. We've seen economies open up again, although not completely, but definitely a vast improvement in the amount of economic activity. And that has meant that for the full year 2020, the economy is expected to shrink by around 8% in total. So implying that quarters 3 and 4 will be a lot better than quarter 1 and 2. If we have a look at 2021, economic growth projections at the moment for there we're seeing some economists projecting even more than 5% for 2021. One of the ways the government can support economic growth is through the Reserve Bank managing interest rates. And at the moment, given this recent data, we are expecting to see interest rates cut further before the end of this year, maybe as much as 0.5% by the end of 2020. That's good for anybody who's got debt. Your debt costs come down, but it is something that if a large portion of your portfolio is sitting in cash, that is probably worth reconsidering given how low those interest rates are. Now 2020 has been a tough year, both economically and in the markets, particularly with the volatility in the markets. But I continue to believe in the resilience of man, and especially South Africans, to make it through. We've seen businesses adapting. There have been casualties, but we're seeing businesses adapt and position themselves to make the most of what's happening and the opportunities that will exist in the future. If you've got any questions, by all means get hold of us, give us a call. We are privy to some very good information just given the research that we do. An example, I recently attended a webinar with Johan de Ruyter from Eskom, seeing some really good things that are happening there around accountability, around plans. And while load shedding is still going to be with us for probably the next year, there's definitely improvements being made there, but that's something we may talk about on another occasion. If you have questions, particularly around the cash comment I made earlier, please get hold of your financial advisor. We've got some solutions that can help you in that regard. But other than that, it was good to chat, and we'll see you again next time.